G'day guys, and welcome to this business management lesson. In today's lesson, we're looking at key knowledge point 311. That is Unit 3, Area of Study 1, and the first key knowledge point for this area of study. Today specifically, we're looking at types of businesses, and helpfully, this key knowledge point, like many in the study design, includes a list of specific examples that you'll need to know in order to demonstrate your understanding of this key knowledge point. That is, that these types of businesses include sole traders, partnerships, private limited companies, public listed companies, social enterprises, and government business enterprises. We'll begin with sole traders. Now, the easiest way to define a sole trader or to identify a sole trader is that it's a sole person, a sole individual, a single person who owns the whole business. If the business has one owner and one owner only, it's a sole traded business. Some of the features of a sole traded business is that if the business name is different than the individual's name, say you've got old mate Daniel Murphy, if he wants to open a bottle shop that he's going to call Dan Murphy's because Dan Murphy isn't his legal name, he'd have to register that business name with ASIC, the Australian Securities and Investment Commission. However, and this is unique to sole traders, if he wanted to open a business that just used his name, if his bottle shop was going to be called Daniel Murphy, then he wouldn't need to register that business name with ASIC. In the case of every other business type we're going to talk about today, they all have to register their business names. They don't have that option. Of course, every business or any business activity that's undertaken in Australia requires that the operator registers for an Australian business number or an ABN, and a sole trader is no different. A sole trader needs an ABN. One of the features of a sole traded business is that this business type has unlimited liability, which means that the business owner and the business are the same legal entity. There is no legal distinction between the business's money and the owner's money. If the owner runs out of money, then it's likely the business has also run out of money. If the business has to declare bankruptcy, it's likely that the owner is also declaring bankruptcy because there is no legal distinction. This business will pay the individual tax rate, not the business tax rate, not the company tax rate. This business will be subject to all of the individual requirements for occupational health and safety and any council conditions that councils have on where and when people can work. The business will be subject to that as well, because once again, unlimited liability means that there are absolutely no distinctions, no limits to how the business and the individual are viewed. They're the same thing. Some advantages of being sole traded is that this business type is very simple and very inexpensive to set up. You have to register for an ABN or apply for an ABN, an Australian business number. That's free and can be done with a quick Google search. It'll take you about 6 minutes. Certainly, if then also you need to register your business name with ASIC, once again, a quick Google search is going to point you in the right direction, and that's not going to take you very long either. And I'm quite sure, at least I'm pretty sure, both of those processes are completely free. In a sole traded business, an owner has complete control. There's nobody to share with. There's no one to get in an argument with. You can decide everything there is to decide about your business. And of course, it's worth mentioning that there is minimal government regulation of a sole traded business. The laws that apply to individual citizens are pretty much the extent of the laws that apply to a sole traded business, because once again, unlimited liability means that there is no legal distinction between this business activity and the owner themselves. And of course, if there's nobody to compete with, if there's nobody to share with, then the owner gets to keep all of the profits. And that is an advantage of a sole traded business. Of course, disadvantages. Unlimited liability means that there's increased risk for the sole trader. If something goes wrong with the business, if the business gets itself into a dodgy deal with a supplier, or a customer rips off the business in a significant way and the business encounters financial difficulties, that unlimited liability means it's the owner's money that's going to have to pay off those debts, and that can put the owner into financial strife. Of course, because of this risk, it can be really difficult for a sole trader to gain finance, to get approval for loans, and that sort of thing, to gain investment, because sole traded businesses are just a bit more risky. And certainly, if there's nobody to share with, then you can't share burdens and responsibilities. So there's a huge burden. There's a large burden on the owner, and finally, a heavy reliance on the owner's skills. If you as a sole trader don't have well-developed time management or financial management skills, then when the time comes to engage in financial or organizational practices in your business, you'll be at a disadvantage, and that could be a problem for your business. So in a sole traded business, not just a heavy burden in terms of responsibility, but also a heavy reliance on the owner's skills. Now, a partnership is much like a sole trader, but in this case, the business is going to be owned by 2 or more people. If it's one person, it's a sole trader. If it's more than one person, it's a partnership. Typically, each partner will have a share of the liability equal to the proportion of their investment, which, if there's 2 partners, they probably share the responsibility, share the legal burden 50-50. In 3 partners, 33 and a third, 33 and a third, 33 and a third. However, it's important to understand that a partnership, like a sole trader, has unlimited liability. So in the case of some sort of great catastrophe where perhaps through negligence an employee had been seriously injured or even died, the partners who have unlimited liability in this business structure would each be found, or at least be charged with culpability, with responsibility for the conditions that led to this catastrophe. And it's not like they would serve 50% of a jail term. If they were found guilty, they would be equally responsible for whatever happened. So when we're saying that in a partnership, partners share liability, this is usually the way that financial penalties or financial debts are dealt with, not so much all legal responsibilities. And certainly, unlike a sole trader, in a partnership, you have partners that you need to share with. You have partners that you need to work with. And if you don't outline your roles within a business or within any project really very carefully, it's possible that you'll be stepping on each other's toes. It's possible that things will go overlooked and will remain incomplete. So it's very important for the success of any partnership that the partners are able to outline and are confident in their responsibility to the business to avoid conflict and make sure that everything's getting done. Advantages of a partnership, once again, simple and inexpensive to set up. Registering for that ABN and registering your business name with ASIC are very simple processes. Workload can be shared amongst the partners, which is absolutely an advantage of the partnership model when compared to a sole trader. Remember, in the sole trader, we had a heavy reliance on the owner's skills and a heavy burden for the owner as disadvantages. But in a partnership, workload, burden, responsibility can be shared amongst the partners, and certainly the work can be split up based on the partners' different skills and expertise and experience. And certainly risk and debt is shared amongst the partners also. So these are all advantages. Disadvantages: that unlimited liability continues to be a disadvantage for a partnership model, and that can continue to impact the business's ability to attract investment or finance, getting loans and attracting investors. Because once again, unlimited liability means that the owners are not protected if the business does go belly up. There's a potential for disagreements in a partnership. In a sole trader, there's no one to argue with you. In a partnership, you absolutely have people who have just as much stake in the business as you do, and they might disagree with your proposal or your way of doing things. So that could be a disadvantage in your business. And certainly, if you go into business with a partner and they turn out to be not exactly as capable as they'd presented themselves, or perhaps they're a bit of a dodgy dude and they invest your money in a shifty way, perhaps into their own personal accounts, and then nick off to Barbados, then you're going to be responsible. You're going to have a liability for the debts incurred by that partner. And that is a bit of a risk, and it's a bit of a disadvantage of the partnership model. Certainly, one of the base disadvantages, if you don't have to share in a sole trader, well, in a partnership, you have to share the profits. And that means that your share of the profits is going to be half or a third or a quarter of whatever it would have been if you'd gone into that business by yourself, assuming you could have achieved that level of success by yourself. Now, companies. Every business type we're about to talk about is a company. The 2 business types we've talked about so far are unincorporated businesses. Every business that's a company is incorporated, and that means that they've gone through the process of incorporation. Incorporation is a stunningly complex and expensive exercise. So, once again, the two unincorporated businesses we've spoken about so far, simple and easy to set up. These companies are not simple or easy to set up. However, these companies are separate legal entities to the owners. If you were to buy shares in one of these companies, let's use Coca-Cola as an example, and tomorrow Coca-Cola declares bankruptcy, all you would lose is whatever you paid for your shares. The banks aren't going to come after your car and your house to make up the debt that Coca-Cola owes, because Coca-Cola and many companies are separate legal entities. A private limited company is a company that is owned by private shareholders, which means that these shares are not available to the general public. If you want to buy shares in a private limited company, you can only do so if the existing shareholders all agree that you should be allowed to buy shares. And similarly, if you are a shareholder in a private limited company, you can only sell your shares if the existing shareholders agree that you should be allowed to sell your shares. The sale and purchase of shares in a private limited company is limited to private individuals, people who have achieved private permission. Typically, because of this arrangement, a private limited company is owned by up to 50 shareholders. If you have to get everyone to agree to every purchase and sale of shares, 50 people is already a lot of yeses or nos to gather, and certainly getting a meeting of the shareholders together, if there are 50 of them, that's quite a complex thing to do. So typically, you don't see any more than 50 shareholders for a private limited company. One of the features of a private limited company, as with all companies, is that a private limited company has limited liability, which means that there is limits to the responsibility of the owners. The business will be responsible for things like occupational health and safety and paying fair wages and complying with relevant legislation. The owners will be responsible for their own legal requirements, but the owners of this business, the shareholders, will never be personally responsible for the business's conduct. An example of a private limited company you may have come across is VCE Proprietary Limited. They make paper and cardboard products. They're an Australian company. And one way to identify a private limited company is sort of as convention and a bit of a requirement. Private limited companies always have proprietary limited, or the shorthand for proprietary limited, PTY Ltd, after its name. So when we look at VCE Proprietary Limited, we know immediately that it's a private limited company. Advantages of private limited companies include that private limited companies have that limited liability and that they are a separate legal entity. Once again, if the business conducts some sort of behavior, or if the business engages in conduct that is in breach of legislation and there are penalties for that conduct, it's likely that the managers responsible for that conduct might be culpable. Certainly the business might attract fines and the business would have to pay that out of the business's finances. The shareholders would not be responsible for paying off those debts. Now, here's a big one. Companies, all incorporated businesses, get to pay the company tax rate, which for businesses in Australia is a lot lower than the individual tax rate. The numbers vary year to year, but a simple Google search for individual tax rates and company tax rates on the Australian Tax Office ATO website will help you find those figures. And being able to regurgitate those figures in an assessment task on this area of study is probably one way to really demonstrate to your teacher that you know what's going on. But yeah, the company tax rate, much lower than the individual tax rates. And of course, once a business is incorporated and it now has a board and a constitution, the company is much bigger than the founders or the directors. If you start a business as a sole trader and you get in a horrible accident, you have to spend 6 months in hospital, it's likely that for those 6 months, that business is going to struggle to carry on. If you start a business that ends up going through the process of incorporation, you're a private limited company, you have your private shareholders, you have your board, your CEO, your CFO, you have your constitution, it's likely that that business can continue without you. And so that's what we sort of mean when we say the business is bigger than the directors. It's no longer dependent on your skills and your experience. Disadvantages for a private limited company are that it is much more complex and expensive to establish. The process of incorporation requires lawyers. You're going to have accountants. It'll take a long time and a lot of effort. Compared to applying for an ABN and registering a business name with ASIC, much more, infinitely more complicated and expensive. And of course, part of being an incorporated business is there are significantly more reporting requirements to the government. With a sole trader or a partnership, they might have to report their financial status, their income, their revenue, their expenditure to the Australian Tax Office quarterly or even just once a year. For companies, for incorporated businesses, the reporting requirements are much more significant. And one disadvantage of a private limited company is, once again, these shares are not traded freely. The shares are traded on a limited basis, which means perhaps you've invested into a company and maybe you were a bit misled about the future prospects of this company or the financial status of this company, and you would like to get out, you'd like to sell your shares and no longer be associated with the company. Once you're in, if the other shareholders don't agree to your sale of shares, you're stuck. Or certainly for businesses that wish to attract investment by getting new shareholders on board, if the existing shareholders don't agree, that can be a bit of a disadvantage. A public listed company, as the name would suggest, is quite different from a private limited company. A public listed company is one where the shares are traded freely to members of the public, and these shares are listed on a stock exchange. In Australia, our stock exchange is called the Australian Securities Exchange, or the ASX. In America, you might have heard of Wall Street. That's the American system, but in Australia, we use the ASX. And anybody who has the money, who can afford to buy these shares, as long as there's no laws that stop them from doing so, certain countries might set trade sanctions on other countries, which might mean that currently, if you're in North Korea, I'm pretty sure you're going to be stopped from buying shares in Australian companies. But mostly, generally speaking, members of the general public, if they can afford to, they can buy shares in these companies. Once again, it's a company, so a public listed company has unlimited liability and is a separate legal entity. One little key thing to remember about public listed companies is the very first day they list on a stock exchange is called their initial public offering. And perhaps in your class, you might look at case studies of Twitter's IPO many years ago now, but look at what a successful day that was for Twitter and how much money they raised in one day. In other cases, there are case studies that we can look at of businesses whose initial public offering was a bit of a dud, and they opened up the shares to the public and nobody bought them, and the business folded soon after because they'd invested a lot of hope and there was a lot of potential in the IPO as an opportunity to raise investment. And if it doesn't pan out that way, many companies struggle to recover. As we've said, shares can be purchased by any member of the public, assuming that member of the public can afford to buy the shares. And we can identify a public listed company if the name just includes the word limited or the shorthand for that LTD after their name. Mining oil company BHP Billiton Limited is an example of a public listed company that you might have heard of. Advantages for public listed companies include that limited liability and the fact that makes the business a separate legal entity. It can buy land, it can buy assets that are not the responsibility of the shareholders, which is certainly good for a public listed company. Perhaps you've bought some shares, you might not even know what the business really does. And you would hate to find one day that there was a knock on the door from debt collectors who are coming after you because the business owed money. So yeah, the fact that these businesses are a separate legal entity is great for investors. These companies pay the company tax rate, and once again, they're bigger than the directors. Once again, for disadvantages, very similar to a private limited company, highly complex and time-consuming to establish, very expensive. There are massive costs in establishment of a public listed company. Pursuing an IPO, an initial public offering, is expensive and complex in its own right. Certainly, there's more accountability and compliance with a public listed company than with any other business type that we've talked about. Certainly, if you've got members of the general public who are now your shareholders, you need to remain accountable and compliant with their wishes. You need to remain transparent with the direction of the business, what it's doing, how it hopes to achieve its future goals, because these investors, these shareholders, now own part of your business, and you want to keep them happy as much as possible. Certainly, that's where our final disadvantage comes up. If your owners, if your shareholders are unhappy, they have the power to sack the CEO. They have the power to oust the board and demand that the business looks for new management. So one possible disadvantage of being a public listed company is suddenly people that you don't know, the general public, have the capacity to buy into your business and become part owners in your business. And if enough people buy into your business that don't think you're doing a very good job, it's quite possible you could lose control of your company. Now, finally, social enterprises. These are not necessarily public listed companies or private limited companies. They are not necessarily any of the business types we've talked about so far, but they will be one of them. It's not a unique business type. A social enterprise doesn't have some third type of share arrangement. Social enterprises, typically private limited companies, but that might become clear in a second. A social enterprise is a business that exists primarily to fulfill some sort of social objective. Shareholders, people who invest in a social enterprise, typically do so knowing that their investment in this company is unlikely to yield the same sort of financial rewards that investing in a profitable private limited or public listed company can yield. But they typically invest in these companies because they individually, as investors, believe in the social mission or believe in the social objectives of this social enterprise. Social enterprises have to be commercially viable. They have to be able to make a profit. None of these businesses that we're talking about are charities. Charities sort of exist in a gray area. They're not businesses. Typically, charities don't sell anything. They attract a lot of donations. They attract a lot of volunteer work. A social enterprise, like Thank You, sells bottles of water and nappies and body wash and soaps and whatever else it is that Thank You sells. And the profits they make from their business enterprises are allocated to fulfilling their social objectives, which for Thank You is clean drinking water and sanitation-based projects in communities around the world that don't have access to good sanitation. Broadly speaking, the reason I'm saying that these typically are private limited companies is because, typically speaking, a public listed company attracting investment from the general public is going to be able to attract investment based on its ability to generate profit and revenue and make the value of people's investments increase so that shareholders are deriving financial benefit from investment in that company. Because social enterprises aren't typically trying to generate investment through their economic value, they're typically trying to attract investment from people who believe in their mission. It makes sense that investors would be known to the business. They would be known to the existing investors. It could be a very controlled and transparent arrangement that we know why you're investing in this company and you know why you're investing in this company and you're investing to help us achieve our social objectives rather than to make yourself rich. Some advantages of a social enterprise include meeting a social need, can encourage community support, and where a business generates goodwill in a community, that can help the business achieve its financial objectives. So certainly with the example of Thank You, I know for myself, when I go to the store to buy soap, or if I'm going to buy a bottle of water, typically I'll reach for Thank You as a known brand because I know that they use their profits to do good in the world, rather than perhaps their competitors who I'll feel more guilty about because I know that bottled water, just it creates plastic waste. And so sort of that positive association with that brand is going to help attract consumption. And certainly for the businesses within the business, improved morale working for a company that you know contributes positively to the world in some way is almost invaluable. Engaged and motivated employees are much more productive and efficient, and if they have improved morale as a result of working in this business, that will be seen in the way that these employees engage with their work. Of course, one difficulty for a social enterprise is because they're fundamentally less likely to be commercially successful in terms of from the shareholder's perspective. It can be difficult to raise the initial capital to get off the ground. Raising that initial capital, getting investors to inject money into this business to get it started can be very complicated. Typically, we use the word philanthropist for the sort of investor who will invest in projects that don't necessarily have an economic value, but they have a huge social value. And there just aren't that many philanthropists around. So for social enterprises, raising that initial capital can be very difficult. And as the business grows and continues, balancing financial and social objectives can be complicated. For a brand like Thank You, when they began, they were just selling bottled water. They've grown and extended themselves into toiletries and nappies and nappy wipes and those sorts of things. That would have taken investment of their profits. All the while, they've had to balance trying to grow the business with achieving their social objectives that they set out to achieve in the first place. And it can be difficult to balance those two competing demands. What do you spend your money on? Your social objectives or growing the business with the hopes that then that will allow you to make more money to invest in your social objectives? Can be a complicated thing to manage. Finally, we have government business enterprises. These are, for all intents and purposes, a private limited company. They are a for-profit company. They sell goods and services at competitive rates. They make a profit. That profit is allocated, portions of that profit are allocated to the shareholders. The difference between a government business enterprise and any other private limited company is that a government business enterprise has one shareholder, and that shareholder is the government. So Australia Post, NBN Co, Defence Housing Australia are all examples of current government business enterprises. They have a CEO and a CFO. They work very hard to be profitable and deliver a good service and a good product, but a percentage of their profits is allocated in dividends to their one shareholder, which is the government. Typically, the influence of GBEs or government business enterprises on the market is that they will provide a reliable service that helps keep prices down in the market, because the tendency of for-profit businesses in a capitalist economy is to charge whatever they can get away with, where government business enterprises exist to ensure that there is a reliable supply of some product or service in a market, and they will set whatever the going rate is for the good or service within that market. So certainly Australia Post's influence on the market would be reflected in brands like FedEx and other courier brands pricing within Australia. Certainly, a GBE aims to make a profit and increase their value of the investment for the shareholder, which is the government, just like other companies do. If Australia Post suddenly stopped being profitable, you can expect that the government would have questions for the CEO about what's going wrong. Certainly, one advantage of a government business enterprise is that they can rely on the government for their initial investment. The government controls taxation in a country. The government controls, the government controls everything, really. And so access to investment from the government often comes pretty freely. If the government's decided to start a business, the government is going to then inject the resources, the financial resources that this business needs to get off the ground. So substantial investment is usually pretty easily achieved. And certainly, healthy competition to the private sector businesses is going to be an advantage for everyone of a government business enterprise. And certainly one thing a government business enterprise will do is that they will be, well, thanks to that substantial investment from the government, they will often be able to and motivated to invest in developing infrastructure that private companies might not be able to do. For example, Ozpost would be setting up warehouses and access for trucks, so widening roads, etc., around airports and docks for their shipping and postage-related activities. And certainly, warehouses and wide roads for trucks near the docks and the airports is going to allow other courier companies to set up their own businesses in those areas, taking advantage of the wide roads that will fit trucks. Certainly, no private company is necessarily motivated to do the same thing. Of course, disadvantages for a GBE include that strategic directions can change with changing governments. Every few years, we have elections at different levels of government in Australia, and let's say that you're Ozpost and you answer to the federal government, or when the federal government changes as a result of an election, it's possible that the incoming government might have different opinions, a different perspective on what should be your strategic priorities. And so as a business, you've got to be prepared to be told that your mission, your objectives are different now, and you just have to be prepared to deal with that. Certainly, it's a notorious aspect of government that there's a lot of inefficiencies, a lot of red tape, which typically just means administrative nonsense that creates inefficiencies. And so being a business that's owned by government, it's possible, even likely, that your business will be more inefficient as a result of having to deal with this government red tape. Perhaps your reporting requirements are far more complicated than they need to be. Perhaps the way that you get feedback from the government is slow and a clunky process. Maybe it goes through 13 levels of filtering before it actually gets to you and the messages become convoluted. Who knows? I've never been in that position myself. There could be political interference. Not that long ago, the CEO of Australia Post, working with her team, had achieved a significant project, signed some contracts that were worth a huge amount of money to Ozpost. It was really quite a successful thing. That team had been working really hard, and sort of as a bonus for the people involved in that team, they were all gifted a luxury watch each. The Prime Minister at the time stood up in Parliament and declared that this was an outrage, despite being pretty common in multi-million-dollar contract level of business around the world. And the CEO was sacked as a result. And that kind of political interference doesn't typically happen with private limited companies that aren't attached to the government. And certainly, as a result of inefficiency caused by red tape, GBEs may not be as productive as private sector businesses. Certainly, if you don't have a board of shareholders that are all paying attention and their own financial benefit is dependent on your business conduct, it might be that a GBE is a little bit overlooked. Perhaps the minister who's in charge of the GBE at this time doesn't really understand what the business does. And so they think rightly they'll stay out of it. They'll let the business run however they deem appropriate. And then it's possible that the business, with a lack of accountability under those conditions, might start to slow down, might become more inefficient, and might become less productive than it otherwise could be. In summary for this key knowledge point, there are multiple types of businesses, each with its own advantages and disadvantages. The business types that we've talked about today are the business types listed in the key knowledge point in the study design. And those are sole traders, partnerships, private limited companies, public listed companies, social enterprises, and government business enterprises. That's all for today. See you next time.